Failure of Silicon Valley Bank, the second largest bank collapse in U.S. history, created ripples throughout the banking industry. A few days later, it was followed by the closing of New York's Signature Bank, the third largest bank collapse, also in the history of the United States. Now another local bank, First Republic, seems to be in trouble with its rating downgraded to junk by S&P Global Ratings. The banking crisis may become global as Credit Suisse stock took a plunge after fears of its stability became public. Many of us here in Silicon Valley are wondering if our own accounts, regardless of the bank, are safe and if we will have access to our funds when we need them. I didn't anticipate any trouble personally, but Chase Bank put 10-day hold on my last deposit on Tuesday, the first time it happened since I opened my account with them more than 10 years ago. In an attempt to stabilize the banking system, Silicon Valley Bank and Signature Bank were taken over by regulators. All deposits were guaranteed by FDIC, and, at least for now, the banking sector regained some stability. Much time was spent by experts and pundits analyzing the issues leading to the bank collapse. And even more time will be spent in the future to put sufficient safeguards to prevent another similar bank run. What I want to focus on in this video is how these recent events will affect the real estate market here in the Bay Area. If you are thinking about buying a home this year, this video will help you understand the economic forces affecting the housing market. And if you are ready to discuss your home buying plans and get a professional opinion about your situation, follow the link in the description of this video and connect with us. It will take only 30 to 45 minutes to develop a custom home search strategy and outline the first necessary steps. So, how will these bank failures change the real estate market? The biggest change is the interest rates. Next Federal Reserve meeting is set for March 22nd. It was widely expected that they would raise rate by 50 basis points at this meeting. But now, most experts agree that Feds will either keep the rate steady at the current level or will increase them by only 25 basis points. Feds are in a hard spot. They will have to choose between continuing to fight inflation and supporting the banking industry. Whatever they do may have far-reaching effects on the United States and global economy. For now, we can only speculate, because Feds are in the quiet period leading to their monthly meeting, and we're not expecting any announcements from them. The mortgage interest rates, however, closely correlate with 10-year Treasury yields. As soon as Silicon Valley Bank stock fell last Thursday, the yield started a sharp decline and is now back to January levels as investors were seeking a safe place to park their money. If the past is any predictor of the future, the mortgage rate should soon retreat into low 6% territory. According to the Keeping Current Matters analysis, mortgage rates between 6% and 6.5% are indicative of good buyer demand for housing. This is exactly the type of market we experienced early in the year, second half of January, beginning of February, before rates climb over 6.5% threshold. It is too early to gauge the full effect of the Silicon Valley Bank failure on the local real estate market. We will have to wait for a month or even 2 or 3 to see it. But here are 3 factors that will determine the outcome. First, supply of homes for sale. The number of homes that came to the market in February was 36% below the last year level. Only 1,346 homes came to the market in Santa Clara and San Mateo counties in February of this year, the lowest number of new listings on record for this time of year. Second, the demand. Demand remains strong. Multiple offers are still common, even though the buyers were not pushing prices up as aggressively as last spring. General uncertainty, triggered by local companies' layoffs and the decline of tech sector stocks, kept many potential buyers off the market. And third, the interest rate. In large part, the interest rates will depend on the Fed's monetary policy and general economic environment. If interest rates decline triggered by the bank failure fears continue, we may see interest rates dipping below 6%, going back to the last summer level. This may reignite the real estate market and put upward pressure on the prices again. This is Michael Tallis with the Tallis team. With major developments happening daily, if not hourly, I will stay away from predicting the next housing market move. I will continue, however, to monitor and report on all the latest trends. If you found this video useful, support us by clicking on the like button, subscribe to this channel, and hit the notification bell so you won't miss any of our future videos. Till next time.